Hey everyone, welcome back. Today we're diving deep into SCHD, a dividend-focused ETF that many investors see as both a growth and income play. But this isn't just your average high dividend ETF. There's strategy, methodology, and a bit of finesse behind its structure that sets it apart. In this video, we'll break down exactly how SCHD selects its holdings, the factors driving its performance, and whether it makes sense for investors in 2026. We'll also examine recent performance trends, dividend growth, and how this ETF stacks up against peers. By the end of this video, you'll have a much clearer picture of whether SCHD belongs in your portfolio. So grab a notebook because we're getting into the details. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the foundation. SCHD isn't just about throwing a bunch of high-yield stocks together. It's designed with a clear methodology in mind and tracks the Dow Jones U.S. 100 Dividend Equity Index, a carefully constructed benchmark. SCHD uses specific criteria to determine which companies make the cut. This ETF looks for more than just dividend yield. It's looking for sustainability, financial health, and consistency. There's a systematic approach behind what might seem like simple dividend investing. SCHD relies on four primary criteria when selecting companies. SCHD prioritizes companies with a long history of dividend payments, at least 10 consecutive years. This immediately rules out younger dividend payers like Nvidia, which has only recently started issuing dividends. On the other hand, stalwarts like Coca-Cola, which have a long history of paying and increasing dividends, are strong candidates. Additionally, SCHD looks at dividend growth trends. It's not enough for a company to pay dividends. The payouts must show consistent growth over time. Next, SCHD evaluates the financial strength of potential holdings. This includes examining the debt-to-cash ratio, liquidity, and the company's ability to sustain dividend payments. Some companies may distribute 70 to 80% of their cash flow as dividends, which sounds generous, but leaves little room for growth or protection against downturns. SCHD favors companies with a healthier payout ratio, typically 10 to 40%, ensuring they can maintain dividends while continuing to expand their business. SCHD targets the top 25% of dividend yields in each sector, while excluding sectors like utilities and REITs that naturally have higher yields. The goal is to find companies offering strong dividends relative to their peers, rather than relying on industries that are inherently high-yielding. Finally, SCHD limits its holdings to the top 100 companies by market capitalization that meet the first three criteria. This ensures that the ETF consists of large, stable companies capable of weathering market volatility. One nuance here. A stock's position in SCHD can change over time. If a company's price rises significantly while its dividend yield remains constant, its yield percentage may drop relative to other stocks. This can result in the company being removed from the ETF during the annual Reconstitution process. SCHD has delivered solid long-term results, but its short-term performance tells a more nuanced story. Historically, between 2012 and 2022, the ETF performed well, reflecting strong dividend growth and steady market returns. However, from 2023 to 2025, performance lagged compared to broader indices. The numbers tell the story. 2023, SCHD returned only 4.37%, despite the Nasdaq being up around 50%, and the S&P 500 gaining roughly 24 to 25%. 2024, the ETF rose 11.47%, again trailing the broader market. 2025 SCHD returned 4.33% with dividends included, a modest gain compared to other ETFs in similar sectors. In contrast, SCHD is off to a strong start in 2026, with a year-to-date return of 13%, highlighting how past underperformance doesn't necessarily predict the present or future. So why did SCHD underperform in recent years? A closer look reveals two key drivers. Between 2018 and 2023, Broadcom was a major holding in SCHD. It had a respectable 3% dividend yield, but as the stock price surged with the AI boom in 2023, its effective yield fell to about 1%. Lower yields relative to other stocks led to its removal from the ETF, affecting overall returns. SCHD increased exposure to energy companies in 2025. While energy stocks like those in the XLE ETF performed well, XLE was up 7.88% in 2025, SCHD's overall exposure didn't generate the expected boost. Energy made up around 20% of SCHD's portfolio, but its performance lagged behind the broader market, In early 2026, XLE has surged 18% year-to-date, while SCHD is up 13%. This shows a correlation but also underscores how the ETF's composition, sector weighting, and reconstitution schedule can significantly influence returns. Every March, SCHD undergoes a rebalancing process. This is when underperforming stocks are removed and new, higher-yielding companies are added. For example, Broadcom was removed after its yield dropped. Certain energy stocks were added despite mixed performance in 2025. Investors need to understand that March reconstitution can lead to swings in performance, depending on which companies are cut and which are included. Dividend growth is a core reason investors are attracted to SCHD. Over the last 5 years, the ETF has averaged about 9% dividend growth per year, while the 10-year average is roughly 10%. This is respectable, though some other ETFs like DIVB have posted 13 to 14% growth over the last 5 years. Investors seeking higher dividend acceleration may compare SCHD with other dividend ETFs such as VYM, FDVV, or DGRO. One factor currently boosting SCHD's performance is a tech and AI sell-off. Many tech companies have seen declines due to market skepticism over high capital expenditures and earnings expectations. Investors are rotating towards blue-chip, value-oriented, dividend-paying companies, which is SCHD's sweet spot. Other dividend ETFs, such as DVY, are also seeing strong performance, indicating a broader market trend favoring stable, income-oriented holdings. So, should you invest in SCHD today? Here are a few takeaways. Solid long-term performance and dividend history. Diversified exposure to large-cap, dividend-paying companies. Benefit from market rotations favoring value and stability. Recent underperformance in booming markets can be frustrating. Reconstitution can remove high-growth, lower-yield stocks, impacting returns. Dividend growth, while steady, may not outpace some other dividend ETFs. Ultimately, SCHD offers a balance of income and growth, but it may not be the top performer in every market environment. Investors should weigh their goals. Are you seeking stability in dividends or aggressive growth? SCHD aligns more with the former. To wrap up, SCHD is more than a high-dividend ETF. It's a strategically managed ETF tracking the Dow Jones U.S. 100 Dividend Equity Index. Its 4 selection criteria, dividend history, financial health, sector-based yield, and market cap, ensure quality holdings. Historical performance shows solid long-term results, though short-term returns have lagged during booming markets. Dividend growth is steady, averaging 9 to 10%, and rebalancing ensures the portfolio stays aligned with SCHD's methodology. Market trends such as tech sell-offs and rotations to value stocks can temporarily boost performance. SCHD isn't a get-rich-quick ETF, but it offers consistency, dividend income, and exposure to strong U.S. companies. If you value long-term stability and growing dividends, it deserves a closer look in 2026. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.